Hello, welcome back. My name is Yasha and I help young men from the middle class invest in the stock market so that they can actually make some money by doing so, okay? Now, as you can see, I am not at home right now. I am in south of Spain and I'm telling you, traveling with women is completely challenging, bro. They are complaining, they are slow and they are annoying. So, it's quite a bite, bro, I'm telling you. Yeah, but let's leave that aside because today we have some amazing company to analyze. Today we are going to analyze Amazon.com Incorporated with the stock ticker AMZN. I hope I pronounced that correctly. But let's take a look at it, whether we should also add it to our own portfolio or not, okay? Now, as always, we are going to analyze it using this little Canva presentation that I have right now here. So let's begin. First of all, why should you even listen to me? Because I seem like a random guy from the internet. So, my name is Yasha and I help young men from the middle class invest in the stock market so that they can make money by doing so. If you are interested in that, click the first link in the description. Now let's start with the actual analysis. This is going to be very simple, beginner friendly, straightforward, without wasting time whatsoever. So yeah, let's go. As a complete beginner, you should generally care about the following 6 things. You should care about chart, profit, debt, money on the bank account, value, and price. Now here are some quick facts about Amazon. So this is a retail company. As you know, it was founded in 1994, whatever. And you probably order from here as well, so you know how famous it is. Now let's begin with the analysis, and first of all we are going to analyze the chart. So chart, we have a little instruction that tells us chart has to grow for all 10 years. Now what exactly does that mean? That means that I will first of all draw a little exponential line, kinda like that. And now we are going to compare the actual stock price chart, which is here the orange line, with that growing line. And then we want to see whether they follow each other, because the point is that we invest in companies that are growing exponentially. We invest in companies that are constantly growing, and this is what we analyze right now here, okay? So, does the chart grow? Yes or no? Yes, it does. It follows that line quite well, especially here until 2022. Obviously, then here the war happened and all that inflation and everything, probably it was that. But now you can see that the chart is slowly growing, it's catching up with that line. So growth is definitely there. This is what we want to see. So chart is good to go. Now we come to the profit, and for profit we have an instruction that tells us profit has to be in plus and it has to grow as well. Now here is the same story. Here I will draw a little exponential line, kinda like that. And now we are going to compare the profit line or the profit chart with this growing line, okay? Does it follow? Let's take a look. Generally, yes, except here in 2022 where they had minus, okay? So here is one thing. Whenever you have profit and whenever you analyze profit, and then when you see that they have a loss instead of profit, that's immediately a no-go for me. Immediately a no-go, because whenever we invest in companies, we want to invest in companies that are growing, that are having profit, that are profitable, that are expanding, you know, basically good companies, okay? Whenever we see minus or whenever we see loss in the profit, that's immediately a no-go. For me, I don't even analyze the profit chart anymore because I see minus, it's a no-go. No more analyzing, okay? So now we come to the debt, and for debt we also have an instruction. Debt has to be low and it has to decrease through the years, preferably. Now what do we have here? Here we have exactly the opposite, because the debt is actually growing and it's growing exponentially as the profit and chart should. But yeah, this is what we don't want to see. We don't want to see growing debt because that means more trouble in the future. You know, they have to make more money to repay that debt. So generally, you know, we don't want to see that. You know, here is just like with personal finances. If you have more and more debt, it's harder and harder for you to get out of it, you know. So with the companies, it's exactly the same. We want to have companies that have minimum debt. Of course, we cannot avoid debt, but we try to minimize it, okay? Unfortunately, here, that's not the case. Now we come to the money, and with the money, we literally analyze money on their bank account. So this is literally the money that they go to the bank and they tell them, okay, please, here is my bank account, give me 100,000 euros, or they go to bank automat or ATM machine and they withdraw that money. This is exactly the same money that we analyze here, okay? Now, preferably they should have more money than the costs. Why is that important? If they have bank account in plus, meaning that they don't have like minus 100 or whatever, if they have money in plus, that means that they can potentially cover some unexpected events. Okay, for example, war happened in Ukraine, war happened in Israel. If that happens, you know, stock market usually goes down, that brings additional trouble. So if you have money on your bank account, you can potentially on the short term cover all of those unexpected events. Okay, this is why we analyze this. And you can see, bro, they have more money than the costs. How do we know that? Use your brain, you are a smart man. Look, they have plus $46 billion on their bank account. You see that little plus here? This is what we want to see. We want to see positive bank account, especially here, $46 fucking billion. It's absolutely amazing. It's absolutely crazy, bro. So yeah, we want to see bank account like that. Money is higher than the costs. This is amazing, okay? Now we come to the value, and obviously we want to invest in stocks that are undervalued, okay? Now, how do we measure valuation? We measure it by two things. First thing is so-called P/E ratio, and the second thing is called intrinsic value. Now, I know that those two expressions might sound a bit complicated for you. Drop me in the comment if you want to know more about the in-depth description about this, and I will make maybe a video about it. But as a complete beginner, you should follow the framework that you have right now here on my screen, okay? P/E ratio should be lower than 15 for any stock that you analyze, and intrinsic value should be higher than the current stock price. Now, where do we find P/E ratio and intrinsic value? Literally use the internet, write in Google, Amazon P/E ratio, Amazon intrinsic value, and you find the data. It's that simple, okay? Now let's take a look. At the moment of recording this video, a P/E ratio of Amazon was 55, which is slightly, or actually not slightly, it's around 4 times higher than what we want to see. So in terms of P/E ratio, the stock is overvalued, sorry. Now let's take a look at the intrinsic value. Now this might sound a bit complicated for you. Intrinsic value is actually a concept that tells us what should be the current price based on fair value, okay? So the computer makes some complicated calculations in the background based on financial data that it has about the Amazon, and based on that data, the computer gives you the price that the stock should have at this exact moment, okay? Let's take a look at our example right now here. So intrinsic value of Amazon is $123, but the actual stock price is, let's say, $200, okay? Now, what does that tell us? That tells us that the stock is actually by 80 euros or dollars higher than it should have been. You know what I mean? Basically, intrinsic value tells you what price should Amazon have, but the price, as you can see right now here, price tells you the actual price that it has. It's that simple, okay? Now, intrinsic value in this case is lower than the current price. That means that the Amazon stock is overvalued in that case as well. So Amazon stock is overvalued both with intrinsic value and P/E ratio. And now we come to the stock price. So price has to be lower than 150 euros, or since you are probably from America, $150 for you, okay? Now we can see that the stock price of Amazon is currently around $200 because they had a couple of stock splits. That's why the stock is so low, you know, but it's still higher than 150, which is what we don't want to see, because 150 euros or dollars for you is the border between overpriced or underpriced stock, okay? We don't want to invest in stocks that cost too much. We don't want to spend money, we want to make money, okay? And this is exactly the opposite here, because the stock price is for about 50 euros or dollars overpriced. Still, that's a no-go, bro. Unfortunately, we have to be harsh here. So no, okay? Now we come to the actual analysis, now we come to the final evaluation, where we are just going to summarize everything that we found out about this stock so far, okay? Now, does the chart grow exponentially? Yes, it does. If you don't believe me, go a few minutes back and you will see the video yet again, okay? Does the profit grow? Yes, it does technically grow, but the problem is that they had loss in 2022, I believe, so profit is immediately a no-go for us. I will just make a huge cross here. This is what we don't want to see. Does the debt decrease through the years? No, it does not. That's why debt is also a no-go. Do they have money on their bank account? Yes, they do. They have, I think, around $20 billion. Correct me if I'm wrong. Is the stock undervalued? No, it isn't. And is the stock price below 150 euros or dollars? No, it's not. So, what do we have here now? The summary of Amazon is that, in my opinion, you should not buy this stock because they had loss in 2022. This is one of the main reasons why you should not invest in the stock. I told you, we don't want to have stocks that have loss. We want to have stocks that have profit. It's that simple, okay? Additionally, the stock price is overvalued. It's around 200, given the fact that it was also splitted. So you know that the stock without the split would be right now probably 1,000 euros or dollars. Additionally, the stock is a bit overpriced, so that's another no-go for me, you know. Now, if Amazon wouldn't have that loss in 2022, this is amazing buy because the company is actually growing. Look, I will show you more in-depth valuation right now here that I prepared. Look, it's growing. Total revenue is growing. Gross profit is growing. Gross profit margin growing. Operating income growing. Net income growing. Net income margin growing. Debt is decreasing in according to equity. You know what I'm saying? Look, retained earnings. They are reinvesting money into the company. Like, Amazon is an amazing buy if it would have not had that loss in 2022. So that's unfortunately what happened. That's why I don't want to buy it. I have my rules and I stick to them, and I'm strict by doing so because you need to have discipline on the stock market, okay? Stock market is not about growing and falling and charts and calculations. It's mostly about how you behave, okay? So in my opinion, bro, yet again, I would not buy this. Unfortunately, they had loss. We don't want to see that. So yeah, that's about it. So if you want to know more about stock market, if you want to have more one-on-one coaching, click subscribe, join me on my journey. Click the first link in the description as well. I will teach you everything about stock market so that you can make money. Do the hard work, bro, and see you on top of the world.